Hi, welcome to Boring Money, Rich Life. I'm your host, Joy Hicks, and today we're going to talk about buying the dip. So, that term just means buying stock when there is a decline. So, the average person, they like to see their stocks, doing good, soaring. I think that's anybody, right? Like, everybody is okay when the stocks are up, it's increasing, things like that. But a lot of people panic when stocks start to decrease. So, this past week, the stock market had one of its worst days since COVID in 2020. And there's a lot of panic. People are concerned. People are like, should I sell off my stocks? Things like that. Now, that's kind of like the average person. But there are investors who are like, oh, okay, there's a dip in the market and I'm going to continue to buy and I'm going to actually buy at a discount. And they kind of get excited because they know that they're getting these stocks at a cheaper price. As I've told you guys, I'm doing a lot of learning when it comes to financial education and just trying to increase my financial intelligence. And so I'm kind of watching how people invest and just learning about the different strategies. And there are people who just buy regardless. So, like for instance, there is a YouTuber who I watch, and he kind of invests in the S&P 500. And it doesn't really matter whether it's up or whether it's down. He always continues to buy. So he's kind of on like a regular schedule. He gets paid, and then he allocates a certain amount of money, and he just keeps buying and buying and buying because the S&P 500, it has like a pool of different US companies. And so he believes that the S&P 500 is going to recover just like it's done over numerous market crashes. And so when there's dips, he kind of gets excited because he's looking at buying things at a discount. So there are different types of dips. So I was kind of reading one of his articles, and it was saying that there's like a pullback, which is kind of a minor dip. So let's say that's like a 5 to 10% decrease. Then there's a correction, which is a drop of anywhere from 10 to 20%. Then there's a bear market, which is a drop of 20 or more percent. And then we have, like the crashes and things like that. And during crashes, that's when people, again, they panic because during an actual recession, there's a lot of reasons to panic. So mind you, there's job loss, which we're seeing right now. There's just a lot of uncertainty. Sometimes there's talks of war and like all these different things. So, of course, there's a lot to be concerned about. But if you're going to invest, you have to kind of look at it from a more factual mindset. You have to understand that the market is going to go up and it is going to go down. So that's just how it works, right? So as things become more expensive, like we're seeing now, people stop buying. And so people get a lot more worried about the safety and security of their livelihood. So they stop spending. So, of course, the market is affected. But again, you as an investor, you have to kind of think about it a little bit different. And that's why it's so important to save your money when things are going well, right? Because when there are crashes, let's say, God forbid, there is a job loss or something like that. If you have a nest egg, you're going to feel a lot more comfortable than somebody who is living paycheck to paycheck. They don't have a lot of savings or a lot of investments that they can lean on. And so they might have to pull from their 401ks or all these different things. But if you plan for these things, because we've seen historically that there's always been like market crashes, there's always been recoveries in the market, then okay, it's it's the way that it works, right? Now, I've told you guys before that millionaires are built from recessions. Millionaires are not built when everything is super high. Like, for instance, around 2020, even up until 2021 and early 2022, when people were selling their houses for crazy prices, like maybe $40,000 over asking because the market was so good and it was a seller's market. That is not when an investor is going to go in and make a deal. An investor is going to go in now, probably like when people are kind of tight for money and they need to make a sale and they might not be able to afford their mortgage, because as an investor, you're kind of looking again to buy things at a discount. But when it comes to buying the dip, it is going to be important to know what your investing strategy is. So, if you are somebody who has kind of like a higher risk tolerance and you like to invest in individual stocks and companies, it's going to be important that you evaluate your stock and you evaluate the company that you're investing in. Now, if you're somebody who is a little bit more passive and you are also investing in just like the S&P 500 or something like that, then buying the dip is not necessarily as risky because you're investing in a lot of different companies. And then with the S&P 500, they will remove companies who are not performing. So let's say the entire market is having a dip, that's different. But if you have a company like Sears who just went completely bankrupt, they're removed. So there's a little bit more protection, I would say. Now, it is investing, it's still a risk. You know, you're probably going to lose money at some point in time, but the better you are at understanding your investment strategy, the better you are at evaluating different companies if you are a little bit more active, then buying the dip has a little bit less risk in there. But I will say for the people that I watch, they do tend to invest, like I said, in the S&P 500. And so they're kind of looking at it like even after crashes, the S&P 500, it does tend to recover, whether that took a few years, like after the 2008 market crash, or even a few months. Like we've been seeing it grow up until this point with all of the talks of tariffs and things like that. So for them, again, they're just kind of looking at buying it cheaper. Because I will say, I recently bought a share of an index fund that is kind of aligned with the S&P 500, and that was like $500 a share. And I'm kind of like pinching myself because when I was learning about investing and things like that, even maybe like 2 years ago, 2 to 3 years ago, at that time, this index fund was only $300 a share. And I was kind of like, dang, that's expensive. Like, I could just buy this individual stock, that's maybe like $100 or whatever. And I really should have just did it because I've spent way more on like vacations. So I really should have just put like $1,000 in at that time and got a few shares because now it's like $500 a share. So that's what they're talking about. You're still investing in the same thing, but it's just how much you're paying because the cheaper you can get it, the more you can profit. So that's the whole point of buying the dip. I will say just do your own research. Again, it's going to depend on your type of investment strategy. Like me personally, I'm investing more so for the long term because I work. So, I have a job, I have income. So I don't necessarily need to like live off my dividends and things like that. But it definitely is up to your own strategy. So I would just kind of watch, especially now, because I think everybody's kind of on pins and needles trying to see, are we heading for a recession? Are things going to recover? Are the US and these other countries going to come to some type of resolve? So now might be a good time to definitely start learning more about this as well. And as always, what is one boring thing that you can do today to start fueling your rich life? Again, I'm your host, Joy Hicks. Thank you for watching and be sure to subscribe.